Well, my next guest is known as one of the straightest shooters on Wall Street with the track record of looking around corners and making really big calls before they happen. And right now, well, he's not liking what he's seeing. In fact, this week he shook the market up when he remarked that almost all financial assets are now overvalued. So let's bring in DoubleLine Capital founder, CEO, and CIO, Jeffrey Gundlach. Jeffrey, great seeing you. You've been pretty adamant. I want to start with private credit because you have been so adamant about this. You know, last week you pointed out there's never just one cockroach, but even before then you posted about pay in kind or PIK. And, you know, that's sort of represented in that Blue Owl stock, which is crumbling. Explain to the audience what exactly is going on here.
Well, we had a little bit of volatility earlier this year with the tariff tantrum, and then everything came back to calming down. And throughout the summer into the fall, we've kept at the tightest credit spreads we've had in a long, long time in the bond market. And there was a lot of easy financing, and there was kind of a one rate sort of offerings from some of the CapEx in the data center stuff and all this. But in recent weeks, and maybe it has something to do with the government shutdown and the data not being around, so now people have to look at more anecdotal data, like layoffs of 30,000 at company A and 15,000 at company B, and the ADP data, which is not terribly reliable, but it's been weakening. The household survey is usually more accurate than the establishment survey at turning points, and that's definitely been weaker. So all these things have started to lead to observable changes where the market seems to be bifurcating. So you have triple C high yield spreads have widened out, not insignificantly. High yield spreads broadly have widened out. Corporate, even investment grade corporate spreads are starting to widen out a little bit. And then the private credit thing is starting to be less of a theoretical shakeout where some will be survivors and some may experience troubles. And now starting to see sort of the canaries in the coal mine kind of falling to the bottom of the cage. And we saw one deal where it was called Renovo, where a firm, reputable firm, frankly, had the bonds marked at 100 cents on the dollar. And then a month later, they revised the mark to zero. That's a pretty big change, right. 100 is zero. And in Chapter 7 bankruptcy filing, they stated their liabilities at about $150 million, and they showed their assets to be less than $50,000. Now, I know private credit is less transparent and unregulated largely and all this, but you think that they would all be monitoring their credit positions. It just seems weird to me that you wake up one day and you realize that the debt to equity ratio is 150 million to less than $50,000.
Right.
And that's really an interesting thing. And then a week later, out comes an article that some major private credit firms owned the same position, and the marks had a pretty wide variation on them. The high was at 91 and the low was at 77. Now, 91 to 77 isn't 100 to 0, but that's a pretty big variance. And then anecdotally, I met with one of our large insurance company clients who has very many positions in private credit, and they have 8 managers that own exactly the same position. And the highest mark during a marking period earlier this year, this wasn't terribly recently, but it was here in 2025, the highest mark was at 95 among these 8 managers, and the lowest mark was at 8. So this is starting to show up to be the problem that I've been referencing, is that private credit and private equity, frankly, is being borrowed from private equity. It's sold on a volatility argument primarily. Maybe there's some excess return for illiquidity that you can get, but it's largely a volatility argument. But if the marks are estimates as opposed to true marks, the volatility could end up being realized volatility in the future could be much more than the observable volatility in the past. And then you have the news today that a firm has a publicly traded private credit fund and a non-publicly traded private credit fund, and they wanted to merge the two because the assets, the stock price of the publicly traded one was meaningfully below the stated asset value. Well, I think market participants are pretty smart. I don't think that they're going to be, selling below the value of the assets. And so I'm suspicious if the assets are really higher value than the stock.
Right.
And the other twist was they had this private fund, and they wanted to merge the two. And when they announced the merger, they said that the private investors would not be allowed to redeem until the merger had taken place. This is kind of the thing about unregulated markets, just like the CDO market was previously to the global financial crisis. It's like the Wild West. And it starts out with a sheriff in town and things are going pretty well. But then as the frontier town grows, more people come in trying to exploit opportunity. And you get to have, maybe it started out with the good sheriff and good actors, but it starts to become highly appealing when you have massive asset inflows at high fees, by the way. And it's enticing for people who want to maybe color outside the lines a little bit. And you start to get the potential for problems. And that's what I've been talking about now for a while. But in more recent weeks, with spreads widening out in particular, perhaps being a catalyst, and bifurcation in the yields and CDS of data centers or people like that that are sponsored by major entities and ones that are sponsored by entities that are less convincingly robust, you're starting to see spreads going from very tight to one to the other to something like 200, 300 basis points, and it's happened fairly quickly. So I think that this is showing signs of stress. And you're in a market where pricing is estimated and not known. So it hasn't really been tested yet. And like most credit markets, when they start out, they get tested, and it turns out that some of the ideas that were used to do new strategies and promote growth end up not being terribly sound. And so that happens, that leads people to be fearful.
Right.
And when people are fearful, they don't like being in illiquid assets. And in the global financial crisis, people couldn't fund their private lockup fund commitments when they started to draw them down. So you say you're going to invest in a fund, and the sponsor rightly and responsibly says, we're waiting for it to get cheap. We're waiting for it to get cheap. And when it does, we're going to draw your capital. But when it gets cheap, nobody has any capital because they're already locked up, and everybody thinks it's cheap now because it probably is. And you start getting capital calls, and these entities can't fund them. And so we have, I think, a mismatch here in terms of large asset pools and needs, particularly during times of some stress,
right,
and their liquidity. So this I think could be a problem. So go ahead, Charles.
No, I mean, as you were describing this, and you eventually mentioned collateralized debt obligations, and there were a lot of terms that we learned the hard way during the housing crisis. And, of course, there was a contagion. There was mark to make believe. Anyone was making up their marks. And to your point, this becomes a groundswell of anxiety. And certainly Blue Owl, which is the company you were referring to, we had that chart up. Stock is just completely falling apart. So I want to pick up on this, but also when we come back, I want to shift to the debt conversation, because it's been a concern of Wall Street for a long time. But I want to point out to the audience, January 1st, 1835, President Andrew Jackson paid off the national debt, but that was the last time the U.S. was at zero. Jeff Gundlach, you've been worried about this for a long time. When we come back, let's talk about that, the potential AI bubble, and where there might be some opportunities. We'll be right back. Welcome back, folks. I'm here with the bond king himself, Jeffrey Gundlach. And Jeffrey, I teased the debt. It's something you've been concerned about. We're racing toward 40 trillion. Believe it or not, at one time we were zero. Here's my problem. Here's my concern. I don't think we'll ever stop. I don't think either party will ever have the willpower to slow it, maybe to stop it, maybe slow it down periodically. So the question is, what's the ultimate outcome?
Well, it does seem like we're not going to stop it. I mean, we've got the tariffs put on, and they are bringing in some money. I mean, it's not the 500 billion or trillion that the president says it is, but it is ramping up. And we are approaching about a run rate of 400 billion. But then the president turns around and he says, I'm going to give $2,000 tariff rebate to families, and I'm sure it'll be limited to a certain income level. I've heard 100,000 being bandied around, but I mean, depending upon what that level is, that $2,000 to these households would be somewhere between $400 and $600 billion. So we finally got some revenue coming in to help bring the rate of the deficit to GDP a little bit better. But here we are talking about giving it away.
Yeah.
So it does seem like it's never going to stop. Meanwhile, the bond market has started to act in an unusual way in the Treasury bond market, which suggests that we're getting closer to the hand maybe ultimately being forced here for the Treasury Department and the Treasury officials. And that is that the Fed started cutting interest rates, a year ago, September. And they cut rates 150 basis points. And typically, when the Fed starts cutting interest rates, particularly when they cut it as much as 150 basis points, you get a rally in the bond market. You get a rally all across the yield curve. This time, cumulatively now, with 150 basis points, the two-year Treasury yield is barely down from where it was the day before the first Fed rate cut. And the 30-year Treasury bond has a very negative return since that time period. This has never happened before. Another thing that's interesting is that the S&P 500 corrections, going back to 2000, there have been 13 of them. And when the corrections came, the correction just means a drop of at least 10%. The first 12 times of those 13 historic examples, the recent 13, the first 12, the dollar went up every single time. The dollar rallied when the stock market fell, which meant that the dollar was a flight to quality asset. Earlier this year, in response to the tariff tantrum, the dollar fell as the S&P 500 went into correction mode, and it fell by around 8 to 10%. Something funny is going on here, that the Fed cutting interest rates is not really helping the dollar, certainly.
Right.
Obviously, it wouldn't on a relative basis, and it's not getting long bonds to rally. So my thesis has been for a long time that long rates are going to rise even if the Fed cuts interest rates, particularly if the Fed is cutting interest rates in response to heightened recession risk. Because if there's a recession, we know there's going to be a deluge of Treasury borrowing. It has to be, because tax receipts go down and unemployment stuff goes up. And so pay things up. When that happens, the problem with that is the long bond going up as issuance goes up, the yield going up is going to take us to a very nervous place, where we already have interest expense having gone from $300 billion a few years ago to now up about $1.5 trillion and going higher, because all the bonds that are rolling off in the next 3 years, based on today's interest rate structure, will have higher coupons than the ones that are maturing. So we have an interest expense problem and an issuance problem. So here's my thesis, Charles. I think rates are going to go higher on the long end until such time as it's too painful. And I think that might be somewhere approaching 6%.
Oh.
It might be too painful, and they say we have to do something about this.
Right.
And one thing could be buying back the bonds, yield curve control. They did that in the aftermath of World War II. Or else something really radical could happen, like you change the coupons on all the bonds. Can't change coupons on existing Treasury bonds, you say? Well, that's what they said about mortgages prior to the global financial crisis, and they modified the interest rates on all the mortgages. If that were to happen, it would solve the interest expense problem. You could drop it by about 2/3, but then, of course, you wouldn't be able to borrow anymore.
Right, no one would ever lend you money. Yeah.
That's the goal. That's the goal. We want to get to a place where we're not borrowing any money.
Okay. Less than 4 minutes, though. I got to get your thoughts on this market, the AI bubble. Are you concerned that there's an AI bubble?
Well, it's obviously a huge momentum investment. There's so much passive investment now. The passive assets and passive funds crossed over the assets and active funds, and that just means that money pours in, and they're buying the market cap weighted indices like the S&P 500, and so it's a virtuous circle. And it keeps going until such time as cracks start to appear. I'm not saying cracks are definitively here yet, but things are starting to happen, like I mentioned about the bifurcating of yields and CDS in the AI-related categories. So at some point, it's going to reverse, and the virtuous circle will turn into a vicious cycle. Based on PEs today and the huge amount of non-transparency that's going on in private credit and other things, I'm very cautious. I recommend 20% cash in portfolios. I recommend 40% stocks, mostly foreign stocks like EM in local currency, which has been doing great this year, and then maybe 25% in bonds, where you're taking 10 years in maturities, and commercial mortgage-backed securities are doing very well. There's reduction of fear in the commercial real estate market. And also, the risk-free thing are non-guaranteed mortgages, residential mortgages that were issued 5 or more years ago, because no one is going to default on those mortgages. They have way too much home price appreciation. You'd be stupid as a rock to default on a home when you can sell it for a profit. So there's no credit risk in those residential loans. The commercial market is definitely getting some animal spirits showing up. Maybe it's just in general, animal spirits been picking up. But that's how I see things, and 20% cash, and still I like 10% or 15% in real assets. Some people can buy gold. I do observe that over the past 12 months, gold has gone up over 50%, and Bitcoin has done 0. So it looks like the market is getting a little bit more sober about what's real and what's hype. And at the valuations of the hype assets, I don't want to play just in case the momentum flips the other way, which it probably will within the next year.
Less than a minute to go. The Fed, should they be focused more on jobs right now or inflation?
I think they are more focused on jobs. The unemployment rate's been going up. It's now almost 50 basis points above its three-year moving average. It's likely to move higher based upon the anecdotal data we've had since the government shut down. And the inflation rate the inflation swap market has actually come in. I think the tariff effect on the CPI, people are starting to think that it's dissipating, and I think people don't expect inflation to rise as much based upon the inflation swap market. So the Fed is going to be more focused on jobs, I believe.
I believe so too. There's an enormous amount of economists who don't. Jeffrey, I really appreciate you spending all this time with us. We covered a lot. Thank you so much for your wisdom, and hopefully we'll see you again real soon. Thank you.
Thanks for having me, Charles. Good luck, everybody.
Thanks.